Hello, everyone. Today we're presenting our research on leverage and default risk in private equity leveraged buyouts. Our study examines whether high debt levels actually predict financial distress and whether this relationship changes during economic crisis like COVID-19. Next page, please. Yeah, thank you. Let me start with some context. The private equity industry has grown into a major force in global finance, managing approximately $4.5 trillion in assets as of 2023. A defining feature of PE investment is the aggressive use of debt. When PE firms acquire companies through leveraged buyouts, they typically load these firms with debt to EBITDA ratios of 5 to 7 times, levels significantly higher than what you'd see in public companies. This raises an obvious concern. Does all this debt make these companies dangerously fragile? Particularly during economic downturns, this question became especially urgent during the 2008 financial crisis and again during the COVID-19 pandemic.
Academic literature is actually split on this issue. On one side, we have the value creation perspective. Scholars like Jensen argue that leverage is a disciplining mechanism. It forces managers to be efficient, avoiding wasteful spending, and focus on cash generation. The debt obligations align management with shareholder interests. On the other side is the risk augmentation perspective. Critics argue that excessive leverage reduces financial flexibility and makes firms vulnerable to any revenue shock or credit market disruption. During downturns, these firms simply can't service their debts. So which view is correct? That's what we set out to test. Next slide, please. Our core research question is, does pre-buyout leverage predict post-buyout default in public to private PE deals? We developed two specific hypotheses. Hypothesis 1. Companies with debt to EBITDA ratios above 6 times will have significantly higher default rates than those below 6 times. We chose 6 times because it's frequently cited by regulators as a threshold of concern. Hypothesis 2. This leverage default relationship will intensify during periods of economic stress. Specifically, we expected the COVID-19 crisis to amplify the risk for highly leveraged firms. Both hypotheses seem intuitive. More debt should mean more default, especially during crises. So let's see what the data actually shows.
We analyzed 83 U.S. public to private leveraged buyouts completed between 2010 and 2020. We started with 136 deals from the SDC Platinum database and matched them to composite financial data. After applying our filters requiring positive EBITDA, complete financial information, and confirmed PE banking, we arrived at our final sample of 83 transactions. Our dependent variable is default, which we define broadly as Chapter 11 bankruptcy, missed interest via payments, or distressed debt exchanges. We hand-collected these events from bankruptcy databases, SEC filings, and financial news sources. We tracked these companies through December 2023, giving us at least 3 years of post-bias observations for every deal. Our empirical approach uses a logic model to estimate default probability. The key independent variable is a dummy for high leverage, specifically whether the debt to EBITDA ratio exceeded 6 times at the time of buyout. We also included a copied dummy for deals executed in 2019 to 2020, which will be exposed to the pandemic shock, and an interaction term to test whether leverage effects intensify during crisis. We controlled for firm size using log revenue and included buyout year fixed effects to capture time trends. Let's look at the descriptive. This is where things start to get interesting. Our sample of 83 deals had an overall default rate of 15.7%. So roughly 1 in 6 companies experienced financial distress. The average debt to EBITDA ratio was 2.66 times, huge variation. Standard deviation was 3.12 and the maximum reached nearly 16 times. About 11% of deals crossed that 6 times threshold what we're focusing on. The firms varied enormously in size, ranging from 10 million to over 18 million in revenue, with a median of 490 million. About 18% of our deals occurred during the COVID-exposed period of 2019 to 2020. Also, we split the sample into two groups, 74 deals with leverage below 6 times and 9 deals above 6 times. As expected, the high leverage group had dramatically higher debt levels, averaging 9 times EBITDA compared to 1.9 times for the low leverage group. But here's the surprise. The default rate for the high leverage group was actually lower, 11.1% compared to 16.2% for the low leverage group. Now, this 5 percentage point difference isn't statistically significant given our small sample, but the direction is completely contrary to hypothesis 1. Instead of seeing high leverage predict more defaults, we're seeing the opposite pattern. COVID comparison is equally surprising. Default rate during the COVID period was just 6.7% compared to 17.6% in the pre-COVID years. That's an 11 percentage point difference. However, we also found that average leverage was actually higher during the COVID period, 3.86 times versus 2.639 times in earlier years. So we have more leverage during the crisis period, but fewer defaults. Again, this runs completely counter to hypothesis 2. Let's turn to the multivariate analysis to see if these patterns hold when we control for other factors. Our baseline logic model shows that the high leverage coefficient is negative, within an out ratio of 0.63. This means that firms with leverage above 6 times have roughly 37% lower estimated default odds compared to lower leveraged peers, controlling for firm size and time frame. While this isn't statistically significant at conventional levels, the direction is consistent with what we saw in the descriptive statistics. The firm size variable shows the larger firms have slightly higher default odds in our sample. So again, this isn't statistically precise. The buyout year trend suggests that later vintage deals have modestly lower default risk, potentially reflecting improving credit conditions over our sample period. The interaction model adds the COVID variable and tests whether the leverage in fact changes during the crisis. Here we encountered statistical issue. The interaction coefficient is extremely large and negative because we have only 3 high leverage deals in the COVID period and 0 of them defaulted. This creates what's called perfect separation. The model essentially predicts near zero default probability for this group because it literally observed no defaults. What we can say is that the main COVID effect is strongly negative, indicating that COVID period deals has substantially lower default odds overall. But we cannot definitely test whether leverage defects intensify during crisis, because the high leverage divided by COVID subgroup performed so well that it creates a statistical boundary condition. To make these results more intuitive, we calculated predicted default probabilities for 4 scenarios, holding firm size and time trends at their sample swing. For low leverage firms in normal times, the predicted default probability is about 16.6%. For high leverage firms in normal times, it drops to 11.6%. During COVID, low leverage firms have a predicted default rate of 10.9%. And for high leverage firms during COVID, the prediction is essentially 0. Though this reflects the data limitation we just discussed rather than a precise estimate. The key takeaway across all scenarios, high leverage is associated with lower, not higher default risk.
So, how do we explain these surprising findings? We believe several mechanisms are at work. First, selection effects. P sponsors like deploy aggressive leverage only on exceptionally high quality businesses. Think about it: to convince senior leaders to provide 9 times EBITDA in debt, a company must have extremely stable cash flows, strong competitive positions, and predictable revenues. High leverage may be a marker of deal quality rather than a source of risk. Second, enhanced governance. High leverage deals probably receive more intensive monitoring from sponsors and lenders. There may be tighter confidence, more frequent optional reviews, and more active intervention when problems emerge. Third, regarding COVID performance, the strong performance during COVID reflects governance stabilization programs like the CARES Act, conservative deal selection by sponsors during 2019 to 2020, and importantly, a censoring effect. These newer deals simply had less time to mature into defaults compared to earlier vintages. Now, let me summarize our three main findings. Finding one is that high leverage does not mechanically increase default risk. In fact, we observe the opposite pattern, suggesting that capital structure decisions are endogenous to deal quality. Finding two is that COVID period deals showed superior performance with a 6.7% default rate compared to 17.6% for pre-COVID deals. The crisis did not immediately trigger the defaults many feared. Last one is that we cannot definitely test whether leverage effects intensify during crisis due to the perfect performance of the small high leverage divided by COVID subgroup. In short, neither hypothesis is supported by our data. The story is more nuanced than more depth equals more risk. Now we need to be transparent about our study's limitations. First, our sample is small, 83 deals with only 13 defaults. This limits statistical power, especially for subgroup analysis. Second, there's a censoring problem. Deals executed in 2019 to 2020 have had much less time to default than deals from 2010. This may cause us to underestimate default risk in recent vintages. Third, we face indemnity issues. The finding that high leverage predicts lower defaults strongly suggests that deal quality is endogenous to financing decisions. We couldn't fully control for unobserved factors like covenant strength, competitive moats, or sponsor monitoring intensity, precisely the things that are likely enable aggressive leverage in the first place. So, what do our findings mean for different stakeholders? For regulators, our evidence does not validate the 6 times step 2 EBITDA threshold as a mechanical predictor of heightened default risk. A singular focus on the leverage ratio may be insufficient. Instead, regulatory scrutiny should focus on the underlying quality of cash flows, the strength of business models, and the structural protections embedded in deals: covenants, sponsor support, operational oversight. The leverage ratio alone doesn't tell you whether a deal is risky. For P sponsors and lenders, our research supports the value creation perspective on leverage. Sophisticated P firms appear capable of dealing debt aggressively but selectively. They mitigate financial risk through rigorous underwriting, operational excellence, and enhanced governance, even during severe economic shocks. High leverage in this context is a governance tool and a signal of confidence, not recklessness. However, the key word is selective. Our findings apply to the deals that actually got done by professional sponsors. They don't suggest that leverage is universally safe. Looking ahead, we see several promising research directions. Future studies should move beyond the simple leverage default relationships and investigate the mechanisms more directly. This would require more granular, confidential data on covenant structures, sponsor intervention activities, and operational improvements. Researchers should also examine how to deal quality, competitive positioning, cash flow stability, management strengths, mediate the leverage risk relationship. Longer time series data would help address the censoring problem and capture full default cycles. And finally, comparative studies across different PE sponsors could reveal whether these patterns reflect industry-wide selection effects or differences in sponsor capabilities. In conclusion, our study challenges the conventional wisdom that high leverage in PE deals mechanically increase default risk. We find that 6 times threshold, often cited by regulators, does not predict high defaults in our example. In fact, the relationship runs in the opposite direction. This doesn't mean leverage is risk-free. Rather, it suggests that in the hands of sophisticated PE sponsors, capital structure decisions reflect careful assessments of business quality and risk-bearing capacity. The implication is that we need to look beyond simple leverage ratios to understand PE risk. Deal quality, governance structures, and sponsor capabilities matters enormously.
In other words, our study challenges the conventional wisdom that high leverage in PE deals mechanically increase default risk. We found that the 6 times leverage threshold, often cited by regulators, does not predict higher defaults in our sample. In fact, the relationship runs in the opposite direction. This doesn't mean leverage is risk-free. Rather, it suggests that in the hands of sophisticated PE sponsors, capital structure decisions reflect careful assessment of business quality and risk-bearing capacity. The implication is that we need to look beyond simple leverage ratios to understand PE risk. Deal quality, government structures, and sponsor capabilities matter enormously, suggesting a need for regulatory focus on these qualitative factors rather than statistic balance sheet metrics. Furthermore, our investigation into the economic stress intensification hypothesis, which is hypothesis 2, revealed that the default rate was surprisingly lower during the COVID-19 crisis period compared to pre-crisis years. While this result runs contrary to the expectation that economic shocks amplify financial distress, it suggests that the swift implementation of government liquidity programs, coupled with active balance sheet management by sophisticated PE sponsors, may have effectively mitigated short-term default risks. Given these compounding factors, future research should move beyond simple binary crisis indicators, such as the COVID period, to employ continuous macroeconomic variables, like GDP growth or interest rate volatility, to robustly test the sensitivity of high-leverage deals to diversified economic downturns. This approach will provide a more granular understanding of the true resilience of PE-backed LBOs. In summary, our research contributes to the ongoing academic debate on private equity and financial stability by providing empirical evidence that leverage alone is an insufficient predictor of default risk in the post-financial crisis era. Our findings support the value creation perspective, highlighting the need for nuanced models that incorporate sponsor expertise and operational efficiency. By differentiating between high-quality, high-leverage deals and speculative ones, our research offers valuable insight for investors assessing risk, and crucially, for regulators seeking to establish effective and economically rational oversight of the rapidly expanding private equity industry. The ultimate takeaway is that the risk of an LBO lies not just in how much debt is used, but who uses it and how it is managed. Thank you for your attention and engagement today as we presented the findings of our research, leverage and default risk in private equity buyouts. Does high debt in leveraged buyouts predict financial distress? Your insightful questions and feedbacks are invaluable as we finalize this work.
We hope our empirical analysis of 83 U.S. public to private PE deals from 2010 to 2020 has provided a fresh perspective on the complex relationship between the leverage threshold and subsequent financial distress, particularly in the context of the COVID-19 economic shock.